And there we go. We're over 300 and we're at 12:02. Right on right on schedule. All right, let's go ahead and get started. Welcome to our webinar today, featuring Dr. Evan Herrnstadt from the Congressional Budget Office, or we'll be calling it CBO today. I'm Ed Kearns, the Chief Science Officer at First Street, where we translate climate risk into financial risk through our physically based modeling and open science approach and the data that we produce. All of you that are joining today are interested in climate change and climate risk. As you all know, flood risk, climate change, and insurance challenges, particularly for homeowners and consumers today, continue to be in the news. Hurricane Debbie, recently, flooded large parts of Florida and up the East Coast, causing lots of damage. So these are issues that continue to draw lots of attention from researchers in academia and industry, and also in government, including state and federal government. So today we'll take a look at some federal research. We'll dive into the Congressional Budget Office's recent studies on flood risk, insurance, and climate change impacts on vulnerable communities. So this session promises to offer insights into the United States flood risk, its geographical variations of that risk, flood adaptation efforts, and resource allocation strategies that can be used to protect our nation from the impacts of climate change. So today we'll learn how climate change has motivated Dr. Herrnstadt and CBO's research interests, and we'll discuss the findings of CBO about significant flooding inside and outside FEMA flood zones, along the coast, inland, all across the country. And also take a look at the different strategies for efficient resource management to take on these climate-related changes, or challenges, excuse me. So today, let me welcome our guest today, Dr. Evan Herrnstadt. Dr. Herrnstadt is a principal analyst in the Microeconomic Studies Division at the Congressional Budget Office, where he primarily works on climate change and energy policy. Before coming to CBO, Evan worked in antitrust consulting and was the Kernan Brothers Environmental Fellow at Harvard University Center for the Environment. Evan received his MA and PhD in economics from the University of Michigan. The other I went to University of Miami, so we'll talk about that later, Evan, too. And his BS in economics political science from the University of Iowa. So before we get into the discussion today, just a few housekeeping items first. So we do have the chat open for questions, so please pile the questions into the chat, and then we've got both Jeremy and Molly that will be helping us with getting those questions to us, so we can answer the audience's questions as we go along as well. Please keep in mind, as Molly mentioned in the chat, that CBO does not make policy recommendations, so if you ask for them, Evan won't be able to answer those questions, but that's fine. And very importantly too, we will send out the slides that Evan chose today, as well as a recording of this presentation later for everybody. And if you couldn't make it but you signed up for it, you'll have access to those as well. So if we're ready to go, I think we're ready to go, Evan. Yeah. All right. So before we get into more of the discussions of the findings, we have a lot of our audience today that might not be familiar with CBO and its role in government. So would you like to describe a little bit about CBO, what it does, and what you personally do as part of the organization?
Yeah, thanks, Ed, and thanks to everybody for having me on. It's great to talk about our work. So CBO is a congressional agency. We work for the legislature, but we are aggressively nonpartisan, I would say. We're very, very clear in our mission that we provide information to the Congress, and then Congress makes decisions based on information. So the kind of most prominent role that CBO has in the legislative process is providing budgetary analysis, budgetary scores of prospective legislation. So how much will the deficit increase or decrease as a result of something that Congress is considering? But along the way, we also provide a broader set of studies and reports and working papers on issues that are of interest to members, committees, in particular the budget committees. And those may directly inform our budget analysts' work scoring legislation, and they may just be sort of more of interest on issues that are important to the budget. My division, the Microeconomic Studies division, primarily works on climate, energy, and infrastructure these days. And so my colleagues have, and I collectively have put out quite a bit of work in the last 2 years or so on flooding, natural disasters, climate change impacts. So anything from wildfires to insurance to the Army Corps of Engineers. Much of this has been done with First Streets modeling as one of the inputs. So that's been really nice to work with them to make some of this possible. My role is to do more of this like medium run research on various areas of climate and energy, kind of whatever Congress thinks is going to be important coming up. Yeah, and so the reason that we've gotten into this work on flooding and natural disasters, I mean, I think it's work that we've always done, but we've had this burst of activity because obviously there's been an increase in interest because of climate change. There are just a lot of different budget angles that are relevant, from the National Flood Insurance Program to disaster relief funding to the Army Corps. And then, just members and committees have constituents, and those constituents are affected by these disasters.
Cool. Yeah, thank you. Are all of your reports available to the public or only a subset?
Yeah, we're super transparent. Like anything that goes out pretty much needs to be public. And so all of these are on our website. The slides today are also on our website. There will be links at the end of the slide to all of the reports you see on the screen right now as well. Yep.
Great, thank you very much, Evan. And I've had the pleasure of reading these reports, so I'm going to ask you some questions about them,
Great.
and as we start to discuss this. So um, one of the things that we've been very interested at First Street is focusing on individual properties, and we have found, of course, that for when you're looking at mortgage holdings, that this is the impact of climate change on the possibility of damage or default or whatever. This is a very popular topic at banks and at Fannie and Freddie, the GSEs and such. You did in your reports, you did do analysis, and you showed that the GSEs, when I say the GSEs, I'm talking about Fannie and Freddie in particular, that they're carrying the majority of the damage risk. Could you explain why this is disproportionately allocated across was seemingly disproportionately allocated across the different mortgage holding stakeholders?
Yeah, so a big part of it is just that Fannie and Freddie represent such a huge share of the mortgage market these days. Since the financial crisis, they're something like 3/4 of the mortgages out there. So that's really a big part of it. We see significant risk across all of the programs that you see on the slide here, right? So what this is showing is, so first we look at these different programs. So the GSEs, as Ed said, are Fannie and Freddie. The FHA is the Federal Housing Administration. VA is, Department of Veterans Affairs. And basically, we're just showing the expected annual damage. So if you were to kind of expose these properties to their current level of flood risk many, many times over, this is like the average amount of damage you'd see in a year. And then what we do is we take a 30-year total where we discount the far future to reflect the fact that, you can invest money today and grow it over time. And so what we see is that, the GSEs are facing something like $158 billion of expected flood damage over that 30-year period. And it's growing by about 30 to 40% when we start looking at mid-century climate conditions.
Very interesting. And could you just explain in a few words? This is based upon the present value. What is present value? How do you measure this?
Yeah, so present value is basically, we start with you basically start with these return periods, right? So you have flood depth that is associated with like a 1 in 100 chance every year, or a 1 in 20 chance every year, or 1 in 500 chance every year. And so you may have a really, really damaging flood, but it's very unlikely to occur. You may have a less damaging flood, but it's very likely to occur in each year. And so, as I said before, with the expected annual damage, you kind of take a weighted average of all those to get a sense of, in a typical year, what kind of damage are you facing? And then because a house is like this long-lived investment, you buy a house once, you don't buy it every single year. It's not really an apples to apples comparison to say, oh, I bought this house for $500,000 and I'm facing, expected damage of $1,000 every year. You need some way to make them comparable. And so what we do is we say, if you faced that expected damage every year for 30 years, you could just sum that up, but 30 years from now kind of matters less to you than money you spend today. And the reason for that is that you could invest that money in a different way and grow it out over time. But the basic idea is you're just trying to convert this long series of flows into something that's kind of relevant to you today.
Great. Yeah, thank you for that explanation. And one of the terms you used in there, and other people that have joined our other webinars have heard me use the term before too, of return period, right? And so, if you're not familiar with the term, the 1 in 100-year storm, this is an event that you would expect once in 100 years, or 1% chance annually. 1 in 500 years would be 0.2% annually. But yeah, these are common probabilistic terms that we throw around very casually in the business. But if you're not familiar with that, there's documentation on the First Street website too that explains these kinds of things. So thank you, Evan, for that.
Yeah.
One of the other things, I mean, there's many things that jump out from your reports from this. One of the most striking is the geographical distribution of flood risk around the country. It is not consistent across the country. It's concentrated in certain areas. So yes, if you could say a few words about what your findings had shown.
Yeah, so I mean, if you've read First Street's previous work on flooding or some of the other academic studies that's based on First Street, this map is going to look pretty familiar to you. But what we're showing here is that present value that I showed you before, like the kind of 30-year sum of expected damage, and we just divide it by the total property value in a county. And so you're kind of scaling for the fact that, yes, there's a lot of damage on the coast, but also a lot of people live on the coast, and those houses are worth a lot of money. And so when you do that, you still see that the coastal areas are very exposed, right? You see the Gulf Coast of Texas, Louisiana, Florida, South Carolina on the Atlantic coast. Then you also see the Appalachia is very, very exposed as well. And that's, a function of, steep river valleys, lots of homes built close to those river valleys. And then you see the same thing up in the Mountain West a bit in Idaho, for example. The bottom panel below the map just sort of shows, if you're in a coastal county, you're a lot more likely to face a lot of risk. But at the same time, being inland doesn't, completely protect you. And so, as I said before, this looks a lot like, maps we see from First Street's work all the time with, different outcomes over and over again related to flood risk.
Are these damages, do they take into account any insurance at all, or no, these are just straight up damages?
This is straight damages, so this is insured and uninsured.
Okay, that was a question from the audience. Yeah, thank you.
Okay, yeah. So like if you've got flood insurance, you're still going to show up as facing damage. So this isn't necessarily your uninsured exposure as a homeowner. It's more kind of the overall risk of flood damage.
Okay. Yeah, and related to that flood insurance, one of your reports from CBO spoke about the coverage with flood insurance, with the National Flood Insurance Program in particular. And as many of our audience members know, that there's a requirement that if you have a federally backed mortgage, that you would have also flood insurance, and that's offered through the NFIP as it's called. The take-up rates of people that have actually subscribed for the NFIP, though, it varies geographically and it varies in and outside of FEMA zones. So, yeah, Evan, do you have any, can you share some findings about just we were talking about, like, so you've got this geographically
Yeah.
distributed flood risk. How is the NFIP being distributed among those people with the risk?
Yeah, so we do find that, around 40 to 50% of the expected annual damage to these mortgaged homes occurs outside those special flood hazard areas. So those FEMA zones that are kind of approximately 1 in 100 year flood risk, or at some point in time, we're 1 in 100 year flood risk. And so, yeah, I mean, as we've seen with, Hurricane Harvey, and with, I think you all just put out some recent work on Debbie showing that just because you're outside a flood zone doesn't mean that you're not exposed. Um, and so we're seeing that in this work as well. And my colleague has also done some work on the demographics of communities and how those correlate with flood insurance coverage. Less about the flood zone itself, but
Yeah.
yeah.
Yeah, and that jives well with, FEMA has testified to Congress to the same budget committees you mentioned before about, for the NFIP, that, 40% of claims over the last couple of decades have typically been outside of the significant flood hazard areas. And that is, it's one of the messaging issues that we've also taken on at First Street to make sure people are aware that just if you're not inside a FEMA zone doesn't mean that you're free of flood risk. Obviously not. And with climate change, this is going to continue to increase as well. So yes, it's unfortunately in the news every time we have a heavy rainfall event, because that's one of the things that drives a lot of these damages, is that and that is not taken into account in the calculation of the FEMA flood zones, is that heavy rainfall element, which with climate change continues to increase with severity and continues to increase people's risk. So
Yeah,
very
I'll
good.
say when I was looking for to buy a house in 2021, we were going to look at this one property, and I looked at their flood factor, and like it was surprisingly high. And then I looked at where it was, and it was just there's this one street that just all of the rainfall runoff like channels into, and it made a ton of sense. So I was glad to have that information.
No, I'm glad you're able to use it. Yes, it's always heartbreaking to see some of the media stories after one of these heavy rainfall events, and people being surprised and not being prepared. And typically, the pricing for an NFIP policy, at least before risk rating 2.0, but that doesn't include this from the NFIP. But it used to be one of the best bargains in the insurance business of getting flood insurance for your home that was not in a flood area, but you were still covered. So the NFIP continues to evolve. FEMA continues to work on this with Congress. Risk rating 2.0 pricing is out there now, so we're heading in the right direction, I believe. I don't know if you get any. I don't know if you. None of your analyses that I think I've seen so far, Evan, have included the risk rating 2.0 impacts, because that's still fairly new policy in the federal government, is it not?
Yeah, so I mean, our budgetary baseline, which is what we compare all legislative changes to, does, take into account the fact that premiums are changing and they're expected to change over the next 10 years, right? There's the what 18%, increases are capped, I think, at 18% year over year for these homes that are getting these kind of big increases. And so our 10-year budgetary baseline does reflect the fact that, over time, people are going to be paying different premiums. But the sort of climate impacts work we're doing doesn't really look at that yet.
Gotcha. So in your studies, you've looked both at insurance, and you've also, well, you're looking at risk, you're looking at insurance, you're also looking at flood adaptation features. So those kinds of protections that could be put in place to protect not individual properties, but protecting communities, right? So the idea about flood adaptation is you put features in place that can protect a city or protect a neighborhood from flood. What have your findings shown about how the efficacy of these kinds of approaches? Are they cost effective?
So the working paper that we've put out does focus on these property level adaptations. So it focuses on like buyouts and elevations in
Okay.
particular. Um, we are interested in looking at those other types of interventions like levies and like green infrastructure. But as an economist and not an engineer, this was a more feasible thing for me to work on. Let me move over to this. So, what we found is that there's a lot of residential properties where the avoided damage from elevating or buying out the property, easily outweighs the cost of the project. So nationwide, we found over 1 million projects that would meet that criterion. And that represents like $180 billion of spending if, it was all to happen. The slide that I just pulled up does show that, that varies quite a bit by the income of the community that the project is located in. So there's a lot of these opportunities throughout the income distribution. They do tend to cluster more in higher income communities in terms of money, but in terms of the number of households that would be affected, you kind of get more bang for the buck working in lower income communities.
How much is typically required to, if you recall, like on a per property, what the average is on how much does it cost to actually protect a home?
I think the elevation was somewhere around 100,000. And then the buyout, obviously, there's some, ancillary costs, but a lot of that is just acquiring the property. So you're buying the structure and the land as well. And so that's more in the, $300,000 to $400,000 range nationwide. But as you can imagine, that one varies a ton compared to the elevation costs.
Yeah.
Yep.
But none of these adaptation approaches are cheap. But how do they compare against the damage? So it may be expensive to raise your home, but in terms of avoided damage, is $100,000? Does that end up being cost effective?
Yeah, so when you look at just the projects that are cost effective, those million projects I mentioned before, or I think it's 1.2 maybe even, you get about $2.50 back in avoided damage for every dollar you spend. And that's across everything, right? So that's if you're getting $1 back for every dollar on up to the projects that are just like a no-brainer, right? So that's a big average. So that is to say, there's also, 100,000, 150,000 projects where you get more than 6 to 1 back. So there are these very, very, very high payoff opportunities as well. Yeah.
So a question from our audience is the the changing insurance environment, the increasing costs, is that driving more people to this kind of adaptation, particularly in coastal assets for protection?
That's a really good question. I honestly don't know the answer, but I would expect it makes these look more attractive, and it's a matter of, making people aware of their flood risk and giving them, a menu of options, I think.
Yeah. Yeah, thank you. And then I know you've looked at how this, like you mentioned, or you're showing us here across in the the income distribution. Are there any other demographics that you also measured to show how this risk and how this adaptation is being spread out across American communities?
Yeah, so we really only looked at income quintile. We looked at a couple other measures of like environmental justice and vulnerability, and they look pretty similar for the adaptation work. My colleague, Natalie Tawil, and Adam Abadi and Elizabeth Ash, I want to give them all, their due, worked on just looking purely at risk of flooding over 1 meter, or sorry, 1 foot, and what the communities that face that risk look like. And so on this slide, what we have is 2 panels. The left-hand panel looks at the gray dot, the light gray dots are the share of properties in a community facing a risk of flooding today. And then the blue dot is mid-century. And so what we see is that it's increasing everywhere. The poorer communities or lower income communities tend to be more exposed to risk. And then when you look at the right-hand panel, the at-risk portion of those communities also tend to buy less flood insurance. So not only do you have a higher kind of overall level of risk in these lower income communities, you also have less protection. Um, Beyond income, my colleagues also looked at coastal versus inland communities by the majority race of the householder in that community. So if you have a community for which the majority of householders is white, you're in the pink column. If the majority of those householders are Black, you're in the orange column. And I think this is a really interesting one because when you break it out this way, obviously coastal communities, they're right by water, so they're going to be at risk. But you look at the majority Black communities and that risk from climate change, that increase is 10 percentage points, going from about 17 to 27 relative to the white communities, where the risk is high, but the increase is a lot less pronounced. So it's not just, today, it's also, as we adapt to the changing climate itself, there are potentially these big disparities.
Yeah, we've previously had some questions related to to this racial distribution. Is this potentially a still like kind of the afterglow of the redlining practices that were prevalent in the mortgage industry well into the 1970s in this country, and now we've also had questions about what's often called blue lining now, where certain communities now with higher risk are now viewed as a greater risk of lending. Is there unfortunately starting to see some kind of connection between these effects, or what's the geographical distribution? Are these kind of things lining up with these communities?
Yeah, so the redlining question, we haven't done any specific analysis on that. I'm familiar with some of the research showing that, and it is super interesting and concerning. The blue lining question is a really good one. I think we've gotten sort of mixed information talking to stakeholders, talking to other researchers. I think there is evidence that lenders are starting to think differently about flood risk than they have in the past. And in particular, it's challenging for them to think about not only present day flood risk, but then incorporating the fact that you've got to guess at how it's changing. And so as you have people of different incomes and different races and, some discrimination dynamics, you may get some of these, interactions. I can't really say, but yeah, I think it's like a ripe area for research for sure.
Yeah. A related question from our audience, and you may not know the answer to this, but are there any overlaps in the risk and affordable housing units across the U.S.?
That's a great question, and I don't know that, but I do know that the FHA has just promulgated their new rule on like elevation requirements for FHA loans, and that has gone, I think, to base flood elevation, which is the 1 in 100 year flood depth, more or less, plus 2 feet, which is a more stringent requirement than they've required in the past. And so I think that's, reflecting some, I guess I can't speak for FHA, but in my mind, giving a little bit more space there is kind of reflecting the fact that things are uncertain, things are changing over time. What you think might be a 1% chance flood might be a 2% chance flood. I think, giving that sort of additional headroom reflects a lot of what we're learning about flood risk.
And if you could go back one slide to the uptake rates again.
Yeah.
So, personally, and I've like I said, read all of your reports, but I remember tripping over this figure in particular and these numbers of the coverage uptake because been working in this area for a while and I knew these uptake rates were low, but these were even lower than I expected, right? So what this is saying is that for income levels less than $40,000 within a significant flood hazard area or special flood hazard area, that there's only 4% of mortgage holders or homeowners, I should say, in this case, homeowners that have NFIP coverage?
Yeah, so I think there's a couple reasons that our numbers are pretty low in this report. One of them is mechanical in that we're looking at all properties, not just residential. So there may be some non-residential properties, there may be some properties without structures on them, there may be abandoned properties. And so if those are at risk of flooding, but no one's living there, or it's a commercial property, and so they're maybe more likely to go to the private market, you're not going to see that in the NFIP. That said, um, this includes all places that are like at risk of flooding as per the First Street flood modeling. So this does include some of those homes that are outside of the special flood
Okay.
hazard area, but are still at risk of flooding. So you have a lot of factors, in play here. One is if you're outside a FEMA flood zone, maybe you don't even know you're at risk of flooding. If you're inside, you might not have a mortgage and you might not be required to buy flood insurance. You might have a mortgage, and we still don't, I feel like, as a research community, have a good sense of how good compliance with the flood insurance mandate is. And so I forget if we've covered this, but if you live in an SFHA, the FEMA flood zone, and you have a mortgage that sort of has any like federal component to it, whether that's Freddie and Fannie, whether that's like a federally insured bank is making a loan, you are required to have flood insurance, but the estimates of compliance with that are kind of all over the map. And so the coverage rates, yeah, I mean, they're low, and ours are low for a few different reasons.
Yeah.
So there's a lot of unprotected properties out there, though, I think we can probably safely say.
Yeah, unfortunately, and we see this with the disaster response following events like
Yeah.
Hurricane Debbie. Yeah, right, exactly. So a follow-up question tied to that from the audience is that have you done similar risk analysis looking specifically at commercial properties and their resilience in the highest flood risk zones?
We have not done any commercial real estate analysis, but I know that's something that people are increasingly concerned about. And that's more of a data limitation than anything else. We had better information on residential properties, and I think modeling the damage from our perspective was a little easier. I think First Street has done quite a bit of work on that, which is really nice stuff to draw on.
Yeah. And a follow-up to that was, and also what about publicly owned like community infrastructures? Has that been a target of your research yet?
No, not yet, but that's another big one. And I know that, I think it's something like, it's at least the majority, I think, of the disaster relief fund payouts that come after hurricanes go to public assistance. And a lot of that is clearing public infrastructure, it's repairing public infrastructure, it's investing in protection for the future at the community level. So it's certainly an important dimension.
Yeah. And then I should note too, there was a OMB report that came out, I think at the beginning of 23, that was looking at climate risk to federal buildings and federal property in particular, and comparing FEMA estimates and First Street estimates. So again, if our audience is interested in some of the public infrastructure studies, there is a separate report put out by your colleagues at OMB. Yeah. Okay. Let me look down to see if we've got any other um, uh, questions from our audience. I want to make sure we have enough time to get to some of these, the ones that have come. I've been trying to draw them in as we go along here too. So in terms of um, the geographic variation again too. So um, when you're looking at coastal versus inland, and you're looking at the adaptation approaches to these, is there any distinction between the coastal risk and the inland risk, or does it all look the same when you're evaluating it? Or is there something that jumps out from the inland risk? You showed Appalachia in particular, and Idaho in particular stood out in the maps that you were showing. Is,
Yep.
is there, is there anything special about the adaptation, or is it more effective in those areas than along the coastline, perhaps?
So the way that we modeled it, I think actually, you get a lot of avoided damage on the coastline simply because those areas are subject to things like storm surge that are so damaging, right? Um, and so you can elevate those properties and sort of avoid a lot of that risk. At the same time, in Appalachia, the housing values, the housing prices are lower, right? And so that makes buyouts a little more attractive from a cost comparison perspective. And that's kind of a challenge, not just inland versus coastal, but also in terms of the incomes of the communities. They tend to skew the projects for which the damage avoided outweighs the cost, tend to skew more towards buyouts in lower income and inland communities. And obviously the kind of side effects, I guess, of buyouts and elevations are really different, right? Like you're leaving your community, your people are maybe more reluctant to take a buyout voluntarily. If you start buying out houses without planning it out, you can affect the values of other people's houses, you can affect the property tax base, which can lead to these like downward spirals where infrastructure, is no longer well funded. And so, it's a tricky problem, and I think it just speaks to the fact that you want to have a thoughtful process behind it. Yep.
In some of your analysis, you use what's called the subsidy cost for federally backed mortgage. Could you explain a
Mhm.
little bit for our audience what exactly is the subsidy cost?
Yeah, so let me go back to that slide that has a little bit of our results. So CBO, the way that we handle the federal mortgage programs, the ones that are on budget are basically there's a small USDA program, and then we have Veterans Affairs, we have the Federal Housing Administration, and then we consider Fannie and Freddie to be on the federal budget because of sort of the implicit guarantee that's floating around there. And so when we want to think about how those affect the federal budget, basically what happens is a borrower takes out a loan, a lender, signs that contract, and then the lender goes out and gets a guarantee from the federal government that if the borrower defaults or is late on payments, their payments are basically guaranteed. And that either takes the form of an explicit guarantee, like through Fannie and Freddie, where basically the lender pays what's called a guarantee fee, or they pay for mortgage insurance through the government. And so there's a mortgage insurance premium. So in both of those cases, the government or the GSE is taking in some receipts. They're taking in those fees. But then those fees are paying for some service, right? Which is that when things go wrong, the government steps in and kind of insures the mortgage. And so the subsidy rate is just the difference between the two sides of the ledger. So it's basically if the government is taking in fees that don't cover sort of the expected losses on the mortgages themselves, then it's effectively subsidizing those mortgages, right? It's not kind of charging enough to cover those repayments or defaults or foreclosures. And so we estimate that, and our total subsidy, I think, across all federal mortgage programs is around $10 billion for a year of mortgages. We look at each cohort individually. So all the mortgages originated in 2024 are part of the 2024 budget. And we kind of look out 30 years for the whole life of the mortgage and roll it back using present value the way that we've talked about, more or less. What we find is that when we run our flood damages through that model, the flood damages themselves are responsible for about 2 or 3% of the total subsidy rate. So when you think about all the reasons that people might default on their mortgages, like housing prices go down, they lose their job, they are hit by a hurricane and decide that it's better to just default than to try to rebuild and pay off the mortgage. About 3% of that comes from just the flood damage. And then that increases by another percentage point. So about a 44% increase going from like 2.5 to 3.5 as we move to the 2050 or mid-century climate conditions. So basically, it's an important part now, and it becomes more important over time. And as you can see from this graph, it's pretty concentrated in a few states, and West Virginia is at the top of the list. So again, we see Appalachia, coastal Atlantic, Gulf Coast. There's a lot more factors at play here than just flood damage. There's the structure of the mortgages and the incomes of the borrowers and all that. But you're seeing the same sorts of patterns over and over again.
Yeah. And we learned a lot, or I should say, I learned a lot during the 2008 mortgage crisis about how all this works. So, although it might be a particular state like West Virginia that has the majority of the problem, but it's actually national scope, right? If there's problems in Florida, like in the 2008, maybe Florida was at the tip of the spear in some of those mortgage issues back then, but it certainly had ramifications across the entire nation. Is this an issue that is a risk that's being dealt with by both state and federal, or is it mainly a federal response right now to this kind of risk and how it's evolving?
I mean, I think it's definitely a joint effort, and you see this in the insurance market, right? Insurance regulation is typically done at the state level when we're not talking about flooding, right? If we're talking just
In
about
general.
property insurance, fire insurance, obviously the states do play a big role, and states also play a role in disaster recovery too. It's not just federal funding. So that's important as well. Um, yeah, and I do want to take that opportunity to say, I don't think that this working paper where we talk about the subsidy rate in particular is like a very narrow, like it's a very CBO working paper. It's this like budget feature that we need to estimate as part of our statutory role for Congress. We're not trying to estimate what is the effect of climate change on the mortgage market, right? This is a very narrow slice. And so some of these things you're talking about, like that are, sort of analogous to the 2008 financial crisis. Like this paper's not taking a stand and saying that's definitely not going to happen. It's just that's a different part of the picture, those sort of larger scale devaluations and problems like that.
Yeah, yeah. Thanks for that clarification. I'm not trying to be doom and gloom here at all. That's for sure.
No, no, no. But I mean, it's important to be really clear about, I think, what we actually are estimating in this paper, because it is, it's sort of the natural next step for us at CBO, I think, for this analysis is to run it through our mortgage model. But again, like I said, it's a narrow piece of the puzzle.
Yeah. Yeah, and the mortgage system, just a little editorial here. I mean, what I've learned through all this is that the mortgage system that we have here in the U.S. is very unique to the United States, and it works extraordinarily well when it works, and it works, yeah, very well almost all the time since its inception long ago. And it does what it's supposed to. It's supposed to make it easier for Americans to buy homes and easier for banks to move some of that burden off of their backs and to lend the money again. So yeah, extraordinary system that yes does work very well. In terms of, and so you explained in terms of percentage and basis points of what we see here on the graph, and you said, well, how it's changing in the future. Just for our viewers, how does that relate to some of this size of this risk? How does that relate to some of the other risks that you talked about? The risk to default, like from a major disaster like a hurricane or job losses and stuff. Is this kind of risk level, is this comparable to other things that play into the risk of default?
So like I said, it's about, it's about 3% of the total subsidy rate. And so, it's one factor, and it's sort of in isolation. So it's hard to compare it to something in particular. And you can imagine, like, we've seen from like Carolyn Kuski's research, for example, looking at Hurricane Harvey, where, if you have flood insurance and you get hit by a hurricane, you're much less likely to default. You may prepay your mortgage because you have this insurance claim that allows you some more liquidity. There's a lot of complicated effects there. But that said, like, let's say a hurricane comes, your home is damaged, you also can't work for a couple of months because the business you work at is damaged. Like, there are interaction effects there that are hard to parse out, and just say, this default would be due to the flood damage versus this default is because there's sort of this broader disaster recovery ongoing.
All right, thank you. Yeah. From our audience, and I'll try to take more of our audience questions now because we've got about 10 minutes left here. Has CBO looked at building age? Are newer buildings, or maybe perhaps buildings with different building codes, built to a more resilient standard?
That's a great question. We haven't looked at that specifically, but I do know that there's research out there that, Florida, for example, has updated its building code, and researchers have found that homes built after that upgrade in the standard tend to be a lot less vulnerable to, say, wind damage during a hurricane. So we haven't looked at that directly. It also raises a good point that all of the adaptation work that we've talked about looks at retrofitting existing housing stock, right? Which we have a lot of housing stock and a lot of it's not going anywhere for a long time, so that needs to be addressed. But it is typically a lot more cost effective to build to a higher standard in the first place. Like elevating a home when you build it is considerably cheaper than elevating a home once it's already sitting on a foundation.
Yeah, that's for sure. Related to that, another audience question. What's the difference between the general characteristics of those 1.5 million cost-effective locations versus those found not to be cost-effective, like you said with these retrofits?
Yeah, that's a great question. So as I said before, I think, buyouts tend to be more cost effective in areas with lower property values because you're not just buying the structure, you're also buying the underlying land, which can be like in DC where I live, it's like 70% of the value of my home is just the land that it sits on, right? Um, I think it's generally to a point, larger homes tend to be more cost effective because there's sort of a fixed cost component where if you're going to elevate a home, like right off the bat, you're spending a bunch of money. And so if it's a bigger home, the damage you're going to avoid is going to be larger than if it's a smaller home, but sort of have to pay that first several $1,000s either way. The other thing that matters a lot, especially from an elevation perspective, is just the structural characteristics of the home. So whether you have a basement, whether your home is made of wood versus brick, whether it's got like a slab foundation versus a crawl space, those all tend to play in quite a bit. And that's just on the cost side from the practical perspective of elevating a house. Um,
Yeah, well, while we're on that subject, again from the audience, what are the types of flood mitigation projects like elevation, which you've seen that have the highest rate of return for each dollar invested?
Yeah, so for what we've looked at, it tends to be actually the elevations do better again because the buyout you're paying for the land, and it tends to be mitigation projects on the coast because the damage is just so much larger. Like if you're doing the same project on average, it's going to cost about the same on the coast as it would inland, except you're avoiding these like very, very bad outcomes in the like worst case scenario. That said, there are high payoff projects kind of scattered throughout the country. It's not so easily bifurcated. It's more kind of these tendencies. And when we look at, we do an exercise in the paper where we take like a $5 billion pot of money and we try to assign it to the highest value projects first and kind of work our way down and see how we do. And when you do that, you end up spending disproportionately in like high income coastal areas. And so it turns out that, even doing a little bit of work to equalize the spending across high and low income areas, you adapt a lot more homes and you adapt a much more kind of equal distribution of homes, but you don't actually give up that much in terms of avoided damage, simply because there's so much of this mixing where there are good projects everywhere.
Interesting. Interesting. On the current slide you're showing, we have a question. What is the source of the data used to determine the riskiest counties in the current slide that we're looking at?
It's a great question. Trying to remember now. It's certainly based on First Street in some way. I think it may be the percentage, or I think it may be like the average annual expected damage per property, something like that. But it's based on First Street combined with like some damage modeling that we did under in-house.
Great, thank you very much. Um, two other questions. So, has CBO or First Street done flood risk damage modeling for healthcare institutions or emergency services in at-risk markets or states?
We have not. That's really good idea and a really good question. I think you all have done some work on like critical infrastructure, right?
Yeah, we have looked at because we've assessed every property, so we have pulled out those that are hospitals or healthcare facilities. We have also done places of worship and police stations and ports and stuff like that stuff too. So yes, we and we did have a report that we came out. I think it was last year in 2023, looking at some of that infrastructure. So we're happy to send that around as well. Yeah. Somewhat related to that, because in terms of community, so talking about the municipal space, is some of this risk making its way into municipal credit ratings and or municipal budgets? Is that anything that CBO has looked at yet?
So we haven't looked at that yet. I'm not sure exactly what the federal budget hook is. That's something where, CBO typically does stuff that's kind of specifically relevant to federal budgetary issues. Not that like the muni bond market is not related. I do know that some people have worked on it. I think Ben Keyes at Wharton at the University of Pennsylvania has some papers on municipal bond ratings and bond rates. A couple of people have looked at that, both looking at anticipated sea level rise, and also I think there's some papers looking, in the aftermath of hurricanes. So there is some research out there. CBO hasn't done that yet. I think we have some work in progress that will sort of, tip our hat to the other folks doing research on that, but yeah, nothing yet.
Gotcha. All right. Thank you very much.
Mhm.
Again, from our audience, do you think that expanded FEMA risk mapping for flooding and other hazards would be cost effective, and where would the most valuable investments likely be made?
That's a great question. I don't have an answer for that. I just have personally no sense of what kind of resources FEMA would need to do that. And I don't know if you have anything to say about that.
Yeah, I know FEMA's working on it. Of course, they're with their risk rating, 2.0 work that includes the heavy rainfall flooding that we mentioned before. That's a big step forward, and they also have a project ongoing to look at probabilistic estimates of flood risk that's very similar to what First Street has already done. So they're continuing to push the boundaries on that. And then downstream of that, I think it's a very good question, and and it gets to a lot of things that the federal risk management standard, flood risk management standard, was trying to get to also too, of trying to say, hey, these are these metrics that you can use for determining whether a project or an approach might be cost effective based upon the expected amount of flooding, and making sure that climate change is incorporated into that. So I think it's still, as far as from what I know, and it's been a few years since I left the federal government, but there is a lot of activity going on in the federal government to arrive at the answer to that question. But I'm not sure if anybody knows the answer to that one yet. Another question. Has CBO research assigned any value to using wetland restoration or conservation efforts in order to better manage water to mitigate flooding damages? That's
Um,
a particular kind of measure, yeah.
yeah. So like green infrastructure and that sort of thing. We have not done research on that ourselves. I know that there's like an excellent paper by Hannah Druckenmiller and Charles Taylor that looked at wetlands restoration under the Clean Water Act and looked at downstream damages from that, and has a good sense of that. I think when you say like assigned any value, I think one thing to clarify about CBO is that when we do budgetary scores, um, one thing that's a little challenging is that a lot of the programs we talk about in this space, like the Disaster Relief Fund, those are discretionary spending. So Congress basically gets to decide how much money to appropriate to those. And so we can, sort of think about, okay, well, damage is getting bigger, so like maybe that will scale, maybe damage funding would scale up with that. But from like a statutory or, budgetary score perspective, CBO has to kind of obey certain rules. And one of those rules is that like Congress decides how much money they're going to appropriate. And so we can't sort of speculate about how much that would be.
Okay. This might be the hardest question that we've had today, um, but it's a good one. At what probability or intensity of risk event, whether it's 1 in 100 or 1 in 500, for example, do mitigative efforts become futile, or I might say non-cost effective, or the return of investment is less than less than 1 to 1? Is there a breakpoint
Um,
there, Evan, that you've seen?
Man, that's a terrific question. We haven't done that breakout. I am trying to think. I did dig into some of this at some point. I'm trying to think about what we found. I think, one thing we found that was surprising is just how much of the expected annual damage, and you might have like an intuitive grasp of this, but like I was struck by how important just like 1 in 20 year flooding is. Even if it's relatively minor, it just
Mhm.
happens or is expected to happen so much more frequently than 1 in 100, 1 in 500 annual flooding. And so you can have these really, really potentially intense flood events, but if they're only happening, with a 1 in 500 probability every year, they don't enter as much as you'd think. And in fact, like, one detail that goes into the adaptation work is that we sort of have to like choose when you're elevating how high you elevate. And so we follow some FEMA guidance and elevate homes to the 1 in 100 year flood standard plus a foot. So it's called 1 foot of freeboard. And so in some cases, that's going to capture the 1 in 500 year flood risk. And in some cases, it's not going to fully mitigate it. And when you move that BFE plus 1 around and try BFE plus 2, like obviously, you start to mitigate more damage, it starts to cost a little more, but it's not, I don't remember it being particularly dramatic. So that's the best I can do, but that's a really good question. And I sort of wish that we had done a little sensitivity where we cut things off at 1 in 100 and saw how they changed.
Yeah. No, this has been an interesting discussion today. Evan, thank you so much for your time, and thank you for you and all of your colleagues at CBO, all the research efforts that you put in that's making this country safer against the impacts of climate change by providing this kind of valuable research so that everybody in the country, including Congress, including the appropriators, can use this information for decision making. And at First Street, we're thrilled to see CBO extracting these insights from the data that we've created as well. So thank you so much, not just for your presence here today, but also for everything that you do for the country at CBO.
Well, thanks a lot. It was really fun, and it's really nice to get to talk about all the work we've been doing. And yeah, First Street has been a, great help throughout the process. So
Much appreciated. And for those of you online, we will be sending out links to all of Evan's research and his colleagues' research at CBO, so you'll have that as well as slides. And at the end of his slides, he's got also links to the particular reports that were mentioned here today. So with that, we'll close out. Again, thank you again, Evan. Thank you, everybody, for attending today, and we'll see you next time. Thank you so much. Bye-bye.